Something massive just happened in the gold and silver market, and most people still don't understand what they're looking at. Prices didn't just fall, they collapsed. The kind of move that makes traders freeze, screens go red, and emotions take over. And here's the scary part. Moments like this don't destroy wealth because prices fall. They destroy wealth because people panic at the worst possible time. Today on Stockora, we're going beneath the surface, not the headlines, not the fear, the real story that history keeps repeating, and what smart money does when everyone else is running away. Before we go any further, if you want clear, no-hype market breakdowns that actually help you think like professionals, make sure you subscribe to Stockora right now. We post content like this consistently, and trust me, you don't want to miss what's coming next. Hit subscribe and let's keep going. Now let's be very clear about something. This wasn't a normal pullback. Gold and silver didn't drift lower slowly. They dropped aggressively, violently, almost as if someone pulled the floor out from under the market. Silver especially saw one of those moves where you double-check the chart because it doesn't look real. And whenever you see moves like that, history tells us one thing: something bigger is happening behind the scenes. Most people are already saying, "That's it, gold is done, silver is dead. I'm staying away forever." That reaction, that emotional response, is exactly why these moments create opportunity for a very small group of people. Because markets don't transfer wealth during calm periods, wealth transfers during chaos. So, what actually caused this crash? If you only looked at the charts, you'd think a financial disaster hit precious metals overnight. But the real catalyst came from politics colliding with monetary policy, specifically the surprise announcement around the Federal Reserve chair. The timing caught almost everyone off guard. The news dropped while markets were thin, liquidity was weak, and traders had no time to adjust positions gradually. Prices had to reprice instantly, in real time. For months, markets were pricing in a nightmare scenario, a fear that the Federal Reserve would completely lose its independence, that rates would be slashed aggressively, money printing would go into overdrive, and the US dollar would be sacrificed for political goals. That fear pushed investors aggressively into gold and silver as an immediate hedge. But when the actual Fed chair pick was revealed, the reaction flipped. Not because inflation risks disappeared, they didn't. Not because money printing stopped, it won't. But because the worst-case scenario didn't arrive overnight. The market went from immediate dollar collapse fear to long-term dollar erosion reality. And that difference matters in the short term. This new Fed chair is still expected to be inflationary, still expected to support low rates, still expected to expand the money supply, but he's also seen as experienced, credible, and someone who won't completely turn the Federal Reserve into a political tool. Wall Street viewed this as a less chaotic outcome than expected, and when that happened, the dollar caught a short-term bid. And when the dollar goes up quickly, precious metals usually move the opposite way. But here's what you must understand. This was a repricing, not a rejection. The market wasn't saying gold and silver are finished. It was saying they ran too far, too fast, based on fear that didn't fully materialize in the short term. Now here's where things get really important. Why did prices fall this fast? Why didn't they just drift lower calmly? The answer is leverage. Modern markets are drowning in leverage. Borrowed money stacked on borrowed money. Futures, options, margin. When prices move against leveraged traders, selling isn't optional. It's forced. Imagine owning silver with cash. If silver drops 10%, it hurts. But you survive. You can wait. But if you're using 10x leverage, that same 10% move wipes you out completely. Your broker doesn't ask how you feel. They liquidate you instantly. Multiply that across thousands of traders, and you get a cascade. Margin calls triggering forced selling, triggering more margin calls, triggering panic. This is how markets crash faster than logic would suggest, and this is why leverage-driven moves are always overreactions. On the way up, leverage pushes prices too high. On the way down, forced liquidations push prices too low. That's not theory, that's market structure. And here's the uncomfortable truth. A lot of people just lost years of gains in a matter of days. Not because they were wrong long term, but because they were overexposed short term. That's how leverage quietly destroys accounts. But now let me show you why this story doesn't end here. Right before the crash, margin requirements were raised. Traders suddenly needed more capital to hold the same positions. At the exact moment, prices were already fragile. Platforms experienced technical issues. Liquidity vanished. And during the chaos, reports surfaced that one of the largest short players in silver covered positions near the lows. Is that coincidence? Maybe. Is it familiar? Absolutely. Because this exact playbook has appeared again and again throughout history. In 1980, silver exploded higher. Then rules suddenly changed. Buying was restricted. Leverage traders were wiped out. Silver collapsed nearly 80%. In 2011, silver ran from under $20 to almost $50. Then margin requirements were raised multiple times in just weeks. Prices were cut in half. Panic followed. Every time, the story is the same. Prices surge, leverage builds, rules tighten, forced selling hits, media declares the asset dead, and quietly, accumulation begins again. This time is no different, except for one critical thing. The underlying fundamentals are stronger than ever. Gold and silver are finite. They cannot be printed. They cannot be created with keystrokes. Every single dollar in existence, on the other hand, is being created faster than ever. And over long periods of time, that relationship has only one outcome. Silver, in particular, has something gold doesn't: massive industrial demand, data centers, AI infrastructure, solar panels, electronics, medical equipment, military applications. Silver is pulled by fear and by growth. That makes it more volatile, but also more powerful when both forces align. And that alignment is exactly what long-term investors watch for. Now I want you to pause for a second, because this is the moment where most people check out. Fear sets in, attention drops. But this is also where smart money leans forward. If you're finding value in this breakdown, drop a comment below and tell me what you think about this move in gold and silver. Do you see panic or opportunity? And share this video with someone who's confused by what's happening right now. These conversations matter. In the next part, I'll explain why volatility is not your enemy, why 2026 is shaping up to be a defining year for asset markets, and how some investors are positioning themselves quietly while others swear off markets forever. Now here's the part most people never truly understand, and it's the reason why the same group keeps winning in markets while everyone else keeps starting over from zero. Volatility is not the enemy. Volatility is the mechanism. It's how wealth moves from emotional hands to patient hands. The people who panic during violent moves are the ones funding the gains of those who stay calm. Think about it. Cash feels safe because it doesn't move. But that safety comes at a cost. Every single year, inflation quietly eats away your purchasing power. You don't feel it instantly, but over time, it's guaranteed loss. Meanwhile, assets that actually grow long-term will never move in a straight line. They surge, they crash, they shake people out, and then they move higher again. That's the price of admission. This is why I keep saying that 2026 is shaping up to be one of the most volatile years we've seen in a long time. Leverage across markets is higher than ever. Retail, institutions, hedge funds, everyone is leaning into borrowed money. And when leverage increases, price swings don't get smaller. They get extreme. Massive upside moves, massive downside moves, back to back. Most people look at that and say, "No thanks, I'm out." And that's fine. But what they don't realize is that by avoiding volatility, they're accepting a guaranteed slow loss instead. They're choosing certainty over opportunity. And again, that's a personal choice, but it's a costly one. Smart money sees this differently. They don't fear drawdowns. They plan for them. They expect them. They understand that panic selling almost always happens near bottoms, not tops. And they understand that markets don't reward emotional reactions. They reward preparation. That's why moments like this gold and silver crash matter so much. Not because you can magically pick the exact bottom, nobody can, but because these are the zones where long-term risk-reward flips, where fear is priced in aggressively, where headlines are screaming disaster while fundamentals quietly strengthen. Now let's bring this full circle, because there's another layer here that most people aren't talking about. One of the biggest historical drawbacks of owning gold has always been the same thing. It just sits there, no yield, no income. You hold it for protection, not productivity. And that trade-off has existed for thousands of years, but that's where things start getting interesting. This brings us to today's sponsored segment, and I want to be very clear here. This is not a recommendation. This is an idea worth researching on your own, because if you're the one taking the risk, you should always be the one doing the due diligence. The company is StreamX Corp, ticker symbol STEX, listed on the NASDAQ. They're working on something that aims to change how gold ownership works. The concept is simple, but powerful. What if physical gold didn't just sit in a vault? What if it actually paid you in more gold over time? StreamX has launched a product called GLDY. Each unit represents one fine troy ounce of audited, vaulted physical gold. Tokenized gold itself isn't new. It already exists. But what makes this different is the yield component. Instead of earning yield in dollars, GLDY is designed to generate yield paid in additional ounces of gold. That distinction matters more than most people realize. So where does that yield come from? Not from risky DeFi schemes, not from speculative staking. It comes from institutional gold leasing through a partnership with Monetary Metals, a firm that specializes in gold-denominated financing. Institutions that actually need physical gold for operations borrow it and pay interest in gold. That interest flows back to holders. In other words, the gold doesn't just sit there, it becomes productive. And your holdings compound in gold terms, not in a currency that's constantly losing value. From a balance sheet perspective, StreamX has recently raised over $40 million in equity financing, allowing them to clean up their capital structure and enter the coming year without convertible debt hanging over them. That matters in an environment where capital is expensive and mistakes are punished. Leadership experience also matters. Their chief investment officer has institutional experience managing global equity assets and running flagship value funds. That doesn't eliminate risk, but it does add credibility to execution. One other detail worth paying attention to is that a well-known billionaire precious metals investor reportedly holds a significant stake in the company. Someone with decades of experience in mining finance and metals streaming doesn't allocate capital randomly. Again, not a guarantee, but definitely a signal worth noticing. Zooming out, the broader opportunity here isn't just gold. It's real-world asset tokenization, fractional ownership, around-the-clock markets, faster settlement, more transparency. Major institutions are already exploring this space seriously. Whether it becomes dominant or stays niche is still unknown, but early infrastructure builders tend to matter if adoption accelerates. Of course, there are real risks: regulatory uncertainty, execution risk, market adoption, counterparty exposure. This is not a safe or guaranteed play, and anyone telling you otherwise isn't being honest. Always read SEC filings, always do your own research, but stepping back, the bigger picture is this: we're watching the collision of inflation, leverage, volatility, and innovation all at the same time. And that collision creates chaos for some and opportunity for others. The gold and silver crash isn't the end of the story. It's a chapter. And how you respond to it says everything about your approach to markets. If you stayed until the end of this video, you're already ahead of most people. Let me know your thoughts in the comments. Are you bullish on gold, silver, or something else entirely moving forward? And if this breakdown helped you see the market more clearly, hit the like button and share this video with someone who's confused by what's happening right now. This is Stockora. We're here to help you think deeper, stay rational, and navigate volatility instead of fearing it. Thanks for watching, and I'll see you in the next one. In the next part, I'll explain why volatility is not your enemy, why 2026 is shaping up to be a defining year for asset markets, and how some investors are positioning themselves quietly while others swear off markets forever.